Okay, hello and welcome to this video. So in this video, we'll be covering task A of the APC December 2022 exam. So this is the information on the day. So what we can see over here, this is our inbox. So we have different emails. So we have one from Elijah, the accounting for the Big Ranch acquisition. Big Ranch acquisition pro forma journal entries is the attachment. So it's document A. Okay, I'm just going to switch over into the task. So if we go to the task, so there are 8 tasks, A to G. So task A is what we'll be covering. It says, respond to Elijah Mulabi's email requesting assistance with the review of the draft pro forma journal entries as prepared by Ralph Judges in respect of the acquisition of Big Ranch Pty Ltd. Okay, so we just have to respond to an email, and it relates to the pro forma, the consolidation of Big Ranch. Okay, so let's have a look. We go to APC. So I'm going to go to document A. So here we can see document A, email from Chief Financial Officer to Finance Manager. It comes from Elijah Mulabi, sent on Wednesday at 7 o'clock. Financial Manager to the Financial Manager, subject accounting for the Big Ranch acquisition, and there's an attachment as well. So it says, hi again, as per my email last week, Fajan has not yet prepared the pro forma journal entries with regard to our acquisition of 100% of the equity of Big Ranch for the purpose of preparing the Fajan Group's consolidated FY 2022. Okay, so that's a mouthful. So he's just saying they have not yet prepared. Okay, so we know that. That was based on the information provided in the pre-release. Okay, so we know the Fajan has not yet prepared the pro forma journal entries for the 100% acquisition. So now they're saying our senior accountant, Ralph Judges, prepared the attached transaction summary and draft pro forma journal entries. Ralph has a BCom accounting degree, but admitted to having limited experience with accounting for business combinations. I would appreciate it if you would review the journal entries and provide comments to Ralph before he sends the document for review by our auditors. Be sure to also address matters he may have missed. Okay, so you might just check for completeness. You can send your comments to me via a reply email, and I will forward to Ralph. Thanks so much. Okay. So we just basically have to respond we have to reply to this email. And what do we have to do? We have to, so what does the CFO want us to do? So we must do, I would appreciate if you could review the journal entries, that's 1. Number 2, provide commentary. And then number 3, make sure that the thing is complete. Okay, so we might just make sure we address all 3 aspects. What's very important when you cover an APC question, there will be multiple requests in an email, right? So it's all around one thing, but they have maybe they list specific items. So just make sure you always cover the specific items that they make mention of, and then you can cover anything further that you think or you feel should be added. Okay, but it's very important. So don't just respond to 1. Don't just respond to 2. Make sure we cover all 3. So what's the 3? It is reviewing the journal entries, providing commentary, and checking for completeness. Okay, so let's go to document A. Okay, so here you can see how they do an attachment. They say attachment to email, and then they give, and this is basically how the document has been saved. Okay. So here we say transaction summary. So Fajan acquired 100% of the equity of Big Ranch on 1 July 2022. The purchase price is to be settled as follows. Okay, so in that sentence, we acquired 100%. Now the question we need to ask ourselves, did we acquire 100% of an asset or of a business? So we know we acquired a business. Okay, so therefore, so because on 1 July 2022, we acquired 100%, which is a controlling interest. And as a result, from that day, we need to consolidate. So from 1 July 2022, we have to consolidate. Because it's a business combination, on 1 July 2022, the acquisition date, we need to apply IFRS 3 business combinations. Okay, so that's important to take note. So in this first point or or sentence, we will state that we acquired 100%, which is a controlling interest of a business, and therefore we have to consolidate the business from the acquisition date, which is 1 July 2022. At the acquisition date, we have to apply IFRS 3, okay, which is business combinations, and we'll talk when we answer the question. We'll talk through about that, okay. So just briefly, what's important to take note, IFRS 3, the key principle in IFRS 3 is applying the acquisition method, okay? So the acquisition method involves 4 steps, basically, or four parts. So the first thing is to identify who the acquirer is, meaning who's the parent, okay? So in this case, it's simple. Fajan is the acquirer. The second thing you need to identify is the acquisition date. Okay, so for the acquisition date, it's simple over here, nothing complicated. It is 1 July 2022. Okay, the third thing you need to identify or determine is to recognize and measure all assets and liabilities at their respective fair values. Okay, so that's number 3. And then number 4, we need to determine or calculate goodwill or bargain purchase gain. So that is what we will say. So when we respond to the email, we will give a high level overview, like 1 or 2 paragraphs, and then we will actually answer the questions in terms of reviewing the journal entries, providing commentary, and then checking for completeness. Okay, so what's important to take note, that we acquired 100% on 1 July. So that means on 1 July 2022, we gain control, and as a result, we have to consolidate from that date. Okay. Now take note, our financial year is 1 November to 31 October. So therefore, from 1 November to 30th June, we do nothing, right? But from 1 July 2022 up until 31 October 2022, we have to consolidate. So we will say, what does that mean? What does consolidate mean? Bringing on 100% of the assets, liabilities, income, and expenses on a line-by-line basis. Okay, so we will just state that. Okay, so so that is basically that aspect. So now they're talking about how the purchase price, the purchase price is to be settled as follows. Okay, so now this is the if you in order to calculate goodwill, right? In order to calculate goodwill, the way the goodwill formula works is saying consideration plus NCI minus fair value of net identifiable assets equals goodwill or bargain purchase gain. Okay. Now, in terms of the consideration, the important principle to take note is that the consideration needs to be the fair value of the amount transferred at the date of acquisition. So for whatever we are transferring to the sellers of Big Ranch, we need to determine the fair value at 1 July 2022. Okay, so here they say an immediate cash payment of 14.1 million on 1 July 2022. So a cash on 1 July, there we take the amount as is. The second, a further cash payment of 4.5 million payable on 31 March 2024 should the audited FY 2023 profit of Big Ranch exceed the audited FY 2022 profit by at least 25%. Okay, so it's a future payment based on certain conditions. So we will pay a certain amount at a future date if certain conditions are met. So that is called a contingent consideration. So this here is a contingent consideration. Why? It is a consideration that's payable in the future if certain conditions are met. So it is an amount, 4.5 million, payable in future, 31 March 2024, if certain conditions are met. What is the condition? That the profit of FY 2023 must exceed the profit of FY 2022 by at least 25%. Not any profit, the audited profit numbers. Okay, so that's a contingent consideration. So what we'll have to do over here, and they're not telling us, but we'll have to, this is the commentary we'll have to provide, is that that point is a contingent consideration. So according to IFRS 3, a contingent consideration must be included in the purchase price. A contingent consideration must be included in the purchase price at there is at the and the amount that we will include is the fair value of that contingent consideration at 1 July 2022. So what does that mean? We will have to go and, I mean, we're not in the question, we'll have to just state to say that we'll have to determine the fair value of this contingent consideration as at 1 July 2022. Okay, so that is basically what we will state. Then they say Fajan paid its legal advisors 400,000 Rand to draw up the purchase agreement, which was capitalized to the cost of the investment. So when we incur expenditure for consolidation purposes, so they said, so take note, they capitalized this to the cost of the investment, meaning they included it in the purchase price. Okay. Now, if you read IFRS 3, it's paragraph between, I think, 51, 52, 53, one of those three paragraphs. So one of those paragraphs, I think 52 or something. So that paragraph tells you that legal expenses or direct costs will not be included in the transaction price. Okay, so they did. So we will have to tell them it's not allowed to be capitalized. It needs to be expensed when it is incurred. Okay, so this 400,000 Rand cannot form part of the consideration. It needs to be expensed when it is incurred. So that is the three things. So at this point, so from here up until here, what do we know so far? That on 1 July, we acquired 100%. That gives us a controlling interest. So therefore, 1 July is the acquisition date. We gain a controlling interest. So therefore, we have to consolidate from 1 July 2022. We will say, what does consolidation mean? Consolidation means we will have to bring on 100%. We'd have to recognize, we can use the word recognize because we're dealing with a CFO and a senior accountant, so they would understand. So we will say we'll have to recognize 100% of the assets, liabilities, income, and expenses on a line-by-line basis for Big Ranch. Okay? So that is what we know. So that's what we will state there. Then in terms of the consideration, we will say the 14.1 million is a cash. So for the consideration, we give the principle that we have to recognize, the consideration is determined as the fair value of the amounts transferred at the date of acquisition. Okay. So on 1 July 2022, what are the fair values of all the amounts that have been transferred? So basically, the cash amount of 14.1 million, that will stay as is. This contingent consideration, there is no fair value, so we will have to determine what the fair value of that contingent consideration is at 1 July 2022, and it will also form part of the consideration or the purchase price. Then this 400,000 Rand, the legal cost, that cannot be capitalized, meaning it cannot form part of the cost of the investment. It needs to be expensed as and when it is incurred. Okay, so that's important to take note. So that is so far what we know. So here they're giving us on 1 July 2022, Big Ranch statement of financial position prepared in accordance with IFRS reflected the following. So here they're saying prepared in accordance with IFRS, meaning it is making use of the accounting standards, right? So it is at whatever the respective carrying amounts are. Now remember, we said we are applying IFRS 3 at the date of acquisition. So we are applying IFRS 3 at the date of acquisition. So one of the conditions, so IFRS 3, the main principle in IFRS 3 is applying the acquisition method. We say the acquisition method has 4 parts. So the third one was that we have to recognize and measure assets and liabilities at their respective fair values. Okay, so we have to first identify all assets and all liabilities. Because remember, what is over here? there may be more. What is shown over here may not be all the identifiable assets and may not be all the liabilities that we have to assume. Okay, and then the second thing is we need to measure all the assets and all the liabilities at their respective fair values. So they're telling us this is IFRS, meaning it's not necessarily at fair value. Okay, so cash and cash equivalents, that's fine. Prepayments, that should be fine. There's nothing specific there. Account receivable, we'll have to state whether this is whether this account receivable is at fair value. We need to assess for any impairments or bad debts. Same thing over here. Inventories, because inventory is measured at the lower of cost and net realizable value. So is at the fair value? Can it be higher, or are there further impairments that need to be recognized? Okay, then we have deferred tax. We have furniture and equipment. So in terms of, so this also needs to be at fair value. So is there a fair value adjustment for that, or are there any impairments that need to be taken into account? Then we have a right of use asset and lease liabilities. Okay, so when it comes to right of use asset and lease liabilities, if you go to in IFRS 3, so in IFRS 3, so remember, assets and liabilities need to be measured at, we need to be recognized and measured at the respective fair values. Okay, at 1 July 2022. However, in IFRS 3, there are some exceptions. So there are three categories of exceptions in no particular order, but basically category number one, there's an exception in terms of how, in terms of recognition. Okay. Exception number two, there is an exception, or category number two, sorry, there's an exception regarding the measurement principle. Remember, the IFRS 3's measurement principle is fair value, right? So there's an exception to the measurement principle. And then category number three, where there's an exception to both the recognition and the measurement. So when it comes to right of use assets and lease liabilities, it comes to the measurement principle. Okay, so we won't recognize the right of use asset and the lease liability at the fair values at 1 July 2022, but rather we will measure the lease liability at its present value at 1 July 2022 in terms of IFRS 16. What we're doing actually over here, we're assuming this is a new lease, okay, that the lease is starting on 1 July 2022. So then we need to work out a lease liability as of 1 July 2022, making use of the remaining lease payments. So we work out backwards, okay? In the same way, you would apply IFRS 16 in a normal situation. We're basically applying IFRS 16 over here as if this is a new lease on 1 July 2022, and we have to work out the present value. So whatever the amount happens to be over there, and the right of use asset would equal to that amount. Okay, so that is basically what we will have to state over there. So we can go through, we can group these and say cash and cash equivalents as is. All the other amounts we'll have to assess whether there are any fair value adjustments in terms of, is the current amount below market values, or are the current amounts above market value, and then further impairments needs to be made. Then we can say over here for right of use assets, and then we can keep right of use assets separately. Okay, retained capital, stated capital, retained earnings. So this is the equity at acquisition. So this is equity at acquisition before fair value adjustments. Okay, the loan. So we'll have to have a look in terms of the loan, whether the loan is at fair value. So remember, if we remember correctly, they were like how can I say now? I think they were favorable terms when it came to this loan from the New Finance Corporation, and then same thing with accounts payable. Okay, so just take note of that. So those are the stuff that we will need to look at in terms of recognition and fair value. So just take note. Here's the fair. This is the net asset value at 1 July 2022 before fair value adjustments. Okay, so just take note of that. So here is some additional information. Additional information to be taken into consideration. So they said Big Ranch generated a net profit after tax of 420,000 Rand from 1 November 2021 to 30th June 2022. So remember 1 November 2021 to 30th June 2022. I just want to see something. Okay, so this is at the date of acquisition. Okay, so this information over here is at the date of acquisition, so that's fine. So here, so this is the profit up until 30th June 2022. We don't care about that. It's already sitting in this for 5.4 million. Okay. And then 210,000 for the remainder of the financial year ended 31 October 2022. So we want to consolidate this 210,000 Rand. Okay, so that 210,000 Rand we would have to consolidate. So the journal entries that we need for that. So this is basically what we would want to consolidate. The 210,000, but that is the period that we have control. Okay. So here we have, as a result of the acquisition, Fajin plans to restructure the operations of Big Ranch at an expected cost of 650. The cost relates to changing the layout and updating the decor of the restaurants and is expected to be incurred in early F1 2023. Okay, so what's important to take note over here is the following. Okay, so that this is a future cost. Okay, so this shouldn't impact anything. It's only a future expenditure. We don't recognize future costs. Okay, so that we shouldn't be recognizing any journal entries. Just on this thing over here. So we know the profit for this period, right, from 1 July to 31 October. What we'd have to state, because this trial balance is given to us on 1 July 2022, the date of acquisition, we would need to, and we'll have to tell them this profit needs to be recognized for the period 1 July to 31 October. However, this profit needs to be recognized on a line-by-line basis. We can't just recognize profit, 210,000. It needs to be split up between revenue, cost of sales, other income, other expenses, and so forth. Okay, so that's very important to take note. So we have to state that, because remember at the top we said that we can consolidate, and what consolidation means: bringing on or recognizing the assets, liabilities, income, and expenses on a line-by-line basis. Okay, so that is talking to this one. This is talking to that one. That's no future costs. So now we have Big Ranch has existing relationships with its customers, which were factored into the negotiated price of the business. The Fajin board has placed a value of 4 million on these customer relationships. Okay, so it's an intangible asset. So yes, if we have customer relationships, if we feel we have customer relationships, we can recognize an intangible asset. So the group can. Okay, Big Ranch itself cannot, because it is an internally generated intangible asset. Internally generated intangible assets cannot be recognized as an asset unless it is something like research and development. Okay, that's not research and development. Okay, so therefore they were not able to. Now remember, one of the principles of the acquisition method is to recognize all assets. Okay, so meaning we must also identify assets that's not sitting on the trial balance. Okay, so this is one of it, where we can recognize. However, they said the board has placed a value of 4 million. The board can't place a value. They'll have to get an expert to actually provide a fair value of that customer relationships at 1 July 2022. Okay, so that's important to take note. So we can bring on customer relationships in a business combination. However, it needs to be measured at fair value on 1 July 2022. It cannot just be a number that the board provided. Okay, so we need to understand that. That's the one thing over here. Then they say no employees of Big Ranch will be dismissed. The existing collection of employees will permit Fajan to continue with all operations of Big Ranch as from 1 July 2022. The Fajan board has placed 1.5 million. Okay, so once again, the board can't place a value on something. What's more important, no intangible asset can be recognized for workforce on people. Okay, so we won't recognize anything, and even if we were, once again, the value of 1.5 would need to be a fair value. Okay, so just take note of that. Just so you understand, so what I said now, that is just meeting competence, right? If you want to do higher competence, is by actually providing insight as to how you can go about measuring the fair value of a customer relationship. So this is something that if you were maybe in the uh, someone that maybe in the investment space or corporate finance space, they may have done something of this nature where they have to value customer relationships or something of that nature, right? So they would have some kind of insight. Or if you happen to come across researching this, okay, because maybe you're buying you're buying a business, and part of buying a business is to buy is having the is buy their relationships, right? You place value on the relationships that they have. So then you want to kind of so you then maybe would have researched how you value a customer relationship, okay? But by so that would just be higher competence, but by stating what I already stated, that will at least meet your competence, okay? Um, so I don't know how. Yeah, I don't have experience in how do we value customer relationships. Okay, so this one over here is that over there. There won't be anything because it is a workforce. We can't reliably estimate. So, by default, I-38 don't allow you to recognize an asset for people or for staff. Okay, Big Ranch has disclosed but has not recognized a contingent liability for a claim against a company amounting to um, for a claim against the company amounting to 595. Big Ranch is being sued by an external party. Okay, so this over here, a contingent liability, correctly not recognized but disclosed. Okay, so when we have a business combination, we would recognize this contingent liability as a liability. Okay, so this is what we will say. We'll bring this on as a liability. We'll recognize this as a liability for group purposes. So in terms of IFRS 3, we will recognize this as a liability. Okay, now it comes to the amount. So the amount of 595, this is the amount that they are being sued for. Okay, that is not the amount we will recognize at 1 July 2022. The amount we will recognize at 1 July 2022 would be the fair value at that date. Okay, based on, so what we would say, we'd have to seek expert advice from lawyers that deal with cases of this nature, and so that they can determine whether the claim is remote or whether the claim will most likely take place. If the claim will most likely take place, if they have to determine the fair value of the claim at 1 July 2022. That is basically what we would state. Okay, so there are 5 things over here. So in the first one, to recap, we must recognize the profit of 210,000 Rand from 1 July to 31 October. We have to consolidate that. What's important, we won't consolidate 210,000. We'll have to get the split of every line item making up that 210,000. Examples: revenue, cost of sales, other income, other expenses, and recognize that on a line by line basis. Okay. Then over here, we have number 2, the restructuring cost of 650. So that is a future cost. So therefore, we will not recognize that at any point now. Okay, this will only be recognized as and when it's going to happen. Okay, and then the customer relationships, we will recognize that as an intangible asset. However, the amount of 4 million cannot be used. We need to determine the fair value of the customer relationships at 1 July 2022, and we perhaps have to seek expert advice in maybe a valuation company to do this, like a big four, like one of the audit firms, one of the consulting firms. Okay. Then on here, number of employees. So this one, it's employees. So IAS 38 do not allow us to recognize employees as an asset. Okay. And then this one over here, we will recognize as a liability in terms of IFRS 3. We will recognize as a liability in terms of IFRS 3. But this 595 is the claim. Okay. We need to determine the fair value of the claim at 1 July 2022. So what would we'll have to seek expert advice from the lawyers that is experts in cases of this nature to determine whether there's a plausible whether the claim is remote or whether it will most likely take place, and then if so, what is the fair value at that date. Okay, so that is basically what we'll do over there. Okay, so now we have these journal entries. Okay, so it's important to take note that you may have a journal entries in your head in a certain way. That's okay. However, the question wants us to review this journal entries and perhaps provide commentary. Okay, so here you can see what the accountant is doing. He is taking the journal entries all against retained earnings. Okay, so when you prepare journal entries, like this on a line by line basis, the other side, he is using retained earnings as the other side. The other side will always be goodwill. Okay, so when you prepare pro forma journal entries on a line by line basis like he is doing, then this retained earnings should not be retained earnings, it should be goodwill. Okay, so that's very important. So number one, so you're not going to state the same line over and over. You'll make one line to say, wherever we see retained earnings from journal entries J1 to J4, it needs to be goodwill and not retained earnings. Okay, so that's important. On this one specifically, we don't recognize a provision for restructuring as it is not a past cost, it is a future cost. Okay, that must still happen. It's only taking place in FY 2023. So therefore, we won't recognize this journal entry. Okay, once again, as we stated, all of this needs to be goodwill. Correctly recognize an intangible asset. However, the amount placed cannot be 4 million because this is an amount placed by the board. We need to determine whether the board actually performed a fair value calculation or whether they have sought expert advice. The fact that they say we're just it's a value placed by the board, it's most likely not fair value, and we'll have to probably consult a consulting firm or corporate finance firm to actually determine this fair value for us. Okay, journal entry 3. This one over here, we don't recognize. We cannot recognize an intangible asset for workforce, for staff, as it's people. We cannot determine. There's no we can't control. We are unable to control people. So therefore, this cannot be recognized. Okay, so this shouldn't take place. Then we have provision for legal claim. So retained earnings, once again, it shouldn't be retained earnings, should be goodwill. We should correctly recognize a provision for a legal claim, but this should not be zero. It should be the fair value of the claim at 1 July 2022, as we discussed. Okay. So journal entry 5, J5, stated capital, correct. Retained earnings, this is incorrect because he's taking into account the amounts above. So the amount should simply be, the retained earnings should simply be this 5.4 million. So that's fine. Then we have investment in Big Ranch. So this is incorrect. Okay, so what does he have over here? The 14.1 million cash amount plus the 400,000 legal fees. So what's important to take note, this amount should include the 14.1, should include the fair value at 1 July 2022 of the contingent consideration, and this amount should exclude the 400,000 of the legal costs. Okay, and then so that is that. and then this balancing figure would either be goodwill or a bargain purchase gain. Okay, so what's important to take note, all of these needs to be goodwill. Okay, and then same thing over here, whatever the balancing, the other side, like we have over here, retained earnings, that should be goodwill. Retained earnings should be goodwill. Retained earnings should be goodwill. Retained earnings should be goodwill. Okay, and then this is correct, that is correct, only the number is wrong. This is correct, the number is wrong, then the balancing figure like you have over here is also goodwill. Okay, so just take note over there. So that is basically that. What we also want to state that there would be no NCI. We can state that there would be no controlling interest because of the fact that we have acquired 100% of the equity. So as a result, there's no non-controlling interest. Okay, so that is that on that on this question. Um, the other aspect that we didn't bring in over here is so remember we need to do the consolidation. Okay, so there are two things that are missing. So the one thing that is missing on 1 July 2022. So I think what we need to tell him here also is to state the dates. Okay, so all of these journal entries is journal entries at 1 July 2022. Okay, so that's the one thing. The second thing is what we need to bring in over here is the fair value adjustments for the assets and liabilities at 1 July 2022. So for example, as we said, that furniture and equipment, all of these stuff, is it at fair value? Then similarly over here, the right of use assets, the lease liabilities, we need to recognize the fair values. Okay, how we do it, we'll have to explain how it gets done. Okay, so that's the one thing. The second thing that he didn't bring in is the journal entries from 1 July to 31 October. Okay, so remember we need to consolidate for the FY 2022. So the income and expenses we need to recognize from 1 July 2022. From 1 July 2022 till 31 October 2022. So we have to bring on the separate line items of revenue, income and expenses, basically, depending how you want to do it. Okay, so one of the ways is, one of the ways would be, one of the journal entries, it depends how the journal entries are performed. If we are adding 100% of the books at 31 October so there's one of two ways over here, right? So the typical way would be we bring on when we prepare when we prepare the consolidation, we have 100% of the parent, 100% of the subsidiary. So meaning 100% of Fajan plus 100% of Big Ranch at 31 October 2022. If we are doing that, then we'll have to do some form of elimination journals. Okay, we'll have to do that. The second way is if there's a zero in 1 July, if there is nothing in the books of Fajan, if Fajan's consolidation is currently looking as 100% of Fajan only, then to get into the consolidation, you'll have to do this journal. Then this journal entries are not appropriate. Then these journal entries are not appropriate. We'd have to we'll have to do some other form of journal entries. Okay, so that is basically what we'll have to discuss. So it's very important to think about the starting point of the journal entries. Okay, so we'll have to tell them, listen here, these journal entries is appropriate only if, besides the points we already made that was a problem, but we'll have to say these journal entries would not make sense if 100% of Big Ranch is not included in the books of Fajan. However, if we do bring on 100%, then these journal entries would make sense based on certain things that we made mention of. So I'm gonna switch over now into Excel. Then I'm going to explain this aspect that the way to fix it would be to take Big Ranch as at 31 October 2022, and add it to the and add it to and add it to the books of Fudgen at 31 October 2022. Because in what 31 October, yeah. So then what do we have? We have a starting point where the starting point is 100% of Big Ranch and 100% of Fudgen as is. Then to get to the group aspect, then we can do these pro forma journal entries. So these pro forma journal entries, even if it was 100% correct, it is currently incorrect because we are processing pro forma journal entries to some. So we're processing pro forma journal entries, but Big Ranch is not even in the books of the consolidation. So that's basically the problem that we have over here. But anyway, let us. I'm going to switch over into Excel, and then we can go through this. Okay.